Hey everyone, I'm back with the fourth part of Pgbp chapter question answers from Icai Study Mat. In this video, I'll be covering 5 exercise questions from Icai Study Mat. Okay, so the PDF link you will get in the description. Do watch the video till the end, it is very helpful. Okay, and don't forget to subscribe this channel if you're not subscribed, and also share with your friends so that they can also avail the benefit of this channel. And also click on the bell icon for the more updated videos. I'll try to upload the videos as fast as possible because very few days are left. Okay, so let's start with exercise number 1. Question 1. Examine critically the following cases in the context of the provision contained in Income Tax Act 1961 relevant for the assessment year 2021. Support the answer with relevant case laws and workings. Okay, we have to support the answer with relevant case laws and workings. Mr. Janak is a proprietor of Messrs. Yash Texnet, which is engaged in garment manufacturing business. The entire block of plant and machinery chargeable to depreciation at the rate of 15% has 20 different machinery items as on 31st March 2020. So in the block of asset there are 20 different machinery items and all the machinery are chargeable at the rate of 15%. One of the machinery used for packing had become obsolete and was discarded by Mr. Janak in July. So Mr. Janak had discarded one of the machinery which was used for packing. Okay, and it was discarded in July 2019. SSC filed its return for the assessment year 2021 claiming total depreciation of 40 lakhs, which includes 4 lakhs being the depreciation claimed on the machinery item discarded by Mr. Janak. The AO disallowed the claim of depreciation of 4 lakhs during the course of scrutiny assessment. Okay, the AO disallowed 4 lakhs. Comment on the validity of the action taken by AO. So in this case, Mr. Janak is engaged in a garment manufacturing business. 20 machineries are there in the 15% block of assets, that is plant and machinery. Okay, as on 31st March 2020, and Mr. Janak have discarded one of the assets on July 2019. They have not sold, but it is still in the retention, still in the possession of Mr. Janak, but they have discarded the assets because it has become obsolete. Okay, AO are disallowing the depreciation in respect of that discarded assets. That was 4 lakh depreciation was disallowed. Okay, which are included in 40 lakhs depreciation, total depreciation. In this case, AO disallowing the depreciation of 4 lakhs is not correct because the asset was used for the purpose of business or profession by the SSC. Okay, and it was although discarded, it was not the SSC has not sold the assets, so depreciation will be allowed in this case even though SSC has not used this asset for this particular year for business or profession, as because in the earlier years it was used for the business or profession. Okay, so in this case depreciation should be allowed as it is in the possession of Mr. Janak. So let's see the solution. The issue under consideration is whether disallowance of depreciation made by the assessing officer with regards to the discarded asset in arriving at the written down value of the block of assets is justified. No, it is not justified. One of the conditions for claiming depreciation under section 32 is that the eligible assets must have been put to use for the purpose of business or profession. So it was used for the purpose of business and profession. The other aspects to consider is whether merely discarding an obsolete machinery which is physically available will attract the expression monies payable appearing in section 43(6) so as to deduct its value from the WDB written down value of the block. So they are saying, so it's as per section 43 only money is payable is deducted from the block of asset. So no money payable has been received, so it will not be deducted because it is still in the possession of Mr. Janak. Okay, the fact in the present case are similar to the fact in case of CIT versus Yamaha Motors India Limited Private Limited 2010 328 ITR 297, wherein the Delhi High Court observed that the expression used for the purpose of the business in section 32 when used with respect to discarded machinery would mean the use in the business not only in the relevant financial year or previous year but also in the earlier previous year. So it was used not in this year but it was used in earlier years, so it will be he can claim depreciation on that. The discarded machinery may not be actually used in the relevant previous year, but the depreciation can be claimed as long as it was used for the purpose of business in the earlier years, provided the block continues to exist in the relevant previous year. So in the block is continues to exist, okay, and in the earlier years it was used for the business or profession, so he can claim the depreciation on that discarded machinery. Therefore, the condition for claiming depreciation in respect of discarded machinery would be satisfied if it was used in earlier previous years for the business. So it was used in earlier previous year for the business, so it can claim depreciation. For the purpose of section 43(6), monies payable means the sale price in case of sale, or the insurance or salvage or compensation money is payable in respect of assets. Okay, the money, they are telling the definition of money payable, what I include in that. In this case, the machinery has not been sold as machinery or scrap or disposed of, and it continues to exist. So it has not been sold, as I said, and it continues to exist. Hence, there is no money payable in this case, which alone is deductible while computing the WDV of the block to which it belongs. So it only money payable is deducted, so no money payable is there, so it will not be deducted from the block of asset, and he can claim the depreciation as the block continues to exist and the assets is still in the possession of Mr. Janak. Applying the rationale of the above case, the action of the assessing officer in disallowing 4 rupees 4 lakhs being the depreciation claim attributed to discarded machinery on the ground that the same was not put to use in the relevant previous year is invalid, since the said machinery was put to use in the earlier previous year. Okay, so he can claim the depreciation on 4 lakhs. Hope you have understood. Nice question. Now moving to part B of this question number 1. Let's see the question. X Limited issues debentures in the previous year 1920, which were to be matured at the end of 5 years. X Limited has issued a debentures which will mature at the end of 5 years. The depreciation, the debenture holder was given an option of one-time upfront payment of 60 lakhs debentures, rupees 60 per debenture on account of interest, which was to be immediately paid by the company. Okay, the company is immediately paying that debenture. Company is immediately paying the interest on that. Okay, as the option exercised by the debenture holder, company paid interest upfront to them in the first year itself, and the same was claimed as deduction in the return of income. So the entire amount of interest which has been paid in the first year upfront, the company is claiming deduction on that. But in the accounts, the interest expenditure was shown as deferred expenditure to be written off over a period of 5 years. In accounts where it is we do different thing, because it is written off over a period of 5 years. Okay, during the course of assessment, the assessing officer spread the upfront interest period paid over a period of 5 years term of debenture and allowed only 1/5 of the amount in the previous year 1920, examining the correctness of the action of assessing officer. In this case, as you all know, that interest whatever is paid on as per section 43B, it is allowed. So it will be allowed in the year in which, in the first year upfront only, in that year only entire interest will be allowed, and no disallowance will be made. The assessing officer is not correct to spread the interest over a period of 5 years. It is not correct. Company X Limited can claim the entire interest in the year in which entire interest is paid by the company. Okay, let's see the solution. The issue under consideration is whether, in case where debenture are issued with maturity at the end of 5 years and the debenture holder are given an option of upfront payment of interest in the first year itself, can the entire upfront interest paid be claimed as deduction by the company in the first year, or should the same be deferred over a period of 5 years? And would the treatment of such interest as deferred revenue expenditure in the books of accounts have any impact in the tax treatment? So they are telling the issues. Okay, the fact of the case are similar to the facts of the fact in the Paria Tools Limited versus JCIT 2015 372 ITR 605, wherein the above issue came up before the Supreme Court. In that case, it was observed that under section 36(1)(3), the amount of interest paid, okay, in 36(1), amount of interest paid in respect of capital borrowed for the purpose of business or profession is allowed as deduction. Okay, so in that case, entire interest capital which was borrowed for the purpose of business, okay, and it is allowed as deduction, but it is subject to section 43B. They have not mentioned that thing. Okay, so it is allowed as deduction the moment the option for upfront payment was exercised by the subscriber. The liability of X Limited to make the payment in that year has arisen. Not only had the liability arisen in the previous year in question, it was even quantified and discharged as well in that year. So it was discharged as well, it was quantified by the debenture holder, and it has been paid by the company. So in that year, as per section 43B also, it has been paid. So interest which has been paid in that year, it should be allowed as deduction. So as per the rationale of the Supreme Court ruling in Taparia Tool Limited case, when the deduction of entire upfront payment of interest is allowable as per the Income Tax Act 1961, the fact that a different treatment was given in the books of accounts could not be a factor which could bar the company from claiming the entire deduction expenditure as deduction. So it cannot. We are doing in accounts different treatment, that does not make any difference. The company will be allowed entire deduction, entire interest as deduction in the year in which it is paying to the debenture holder. So upfront it is paying, so entire amount will be allowed in the previous year. Okay. Accordingly, the action of assessing officer in spreading the upfront interest over the 5 years of debentures and restricting the deduction in the previous year 1920 to 1/5 of the upfront interest paid is not correct. So as I said, assessing officer is not correct in this case. The company is eligible to claim the entire amount of interest paid upfront as deduction under section 36(1)(3) in the previous year 1920. Okay, hope you have understood. Now moving to question number 2. Compute the quantum of depreciation available under section 32 of the Income Tax Act 1961 in respect of following items of plant and machinery purchased by PQR Textile Limited by paying through account pay check which is engaged in the manufacturing of textile fabrics for the year ended 31st March 2020. Okay, so we have to calculate the depreciation for under section 32. Okay, and PQR Limited is engaged in the business of textile. Okay, so all the machinery which was purchased, it was paid by an account pay check. So as the criteria says that machinery should be used, machinery should have been purchased only by an account pay check, account pay bank draft, or use of electronic clearing system. Okay, then only we can show in the books of accounts and claim depreciation on that. So it has written that only. So we have to compute that thing. So let's see what are the machinery is given. New machinery installed on 1st May 2019, that is 84 lakhs. New windmill purchased and installed on 18th June 2019. Okay, so on 18th June 2019 windmill has been installed. So as you all know that windmill on or after purchased on or after 1st April 2014, 40% depreciation is allowed on that. Okay, lorry for transporting goods to sale depot purchased and put to use in July 2019. Okay, lorry was purchased. Now let's see items purchased after 30th November 2019. Flock lift truck used inside factory 4 lakhs. Computer installed in office premises 1 lakh. Computer installed in factory 2 lakh. Okay, new imported machinery is 12 lakhs. Okay, we'll see the depreciation, additional depreciation on that. The new imported machinery arrived at Chennai port on 30th March 2020 and was installed on 3 April 2020. New imported machinery, that is 12 lakh. All other items were installed during the year ended 31st March 2020. The company was a newly startup during the year. Also compute the WDV of the various block of assets as on 1st April 2020. Okay, we have to calculate the depreciation and the WDV. Okay, let's see the solution. Computation of depreciation allowance under section 32 for the assessment year 2021. Normal depreciation under section 32(1)(2) and additional depreciation under section 31(2)(a). We have to compute both. Let's see. Plant and machinery 15% block put to use for 180 days or more. New plant and machinery, new machinery installed on 1st May 2019, 84 lakhs. In this we'll get additional depreciation also. So in both the column it is written 84 lakhs and it is used for more than 180 days. So lorry for transportation of goods to depot. So 3 lakhs will, on which only normal depreciation will allowed, additional depreciation is not allowed, as because it is not covered in the machinery part. As it is in additional depreciation portion, it is written that on this type of machinery additional depreciation is not allowed. Okay, so in this case additional depreciation will not be allowed. Okay, so only 3 lakhs will be written in normal depreciation column and it will not be written in additional depreciation column, because it is written in additional depreciation section that ships, aircraft and transported vehicles. In this case, additional depreciation is not allowed. So normal depreciation will be charged on 87 lakhs, and additional depreciation 84 lakhs depreciation will be charged on that. So on normal depreciation will be 15%, additional depreciation will be 20%. Okay, so in this case we are on 87 lakh. If we compute 15%, is coming to 13.05, and on 84 lakhs if we charge 20% depreciation, and then it is coming to 16.8 lakhs. Okay, now let's see next. Plant and machinery 15% block put to use for less than 180 days, hence depreciation is restricted to 7.5%, being 50% of 15%. Okay, so flock lift trucks used inside a factory on 4 lakhs will be written on both, because on this it's not mentioned in additional depreciation section that it will no depreciation will allowed in this. So we are considering it as an in this additional depreciation will also be allowed, but half rate depreciation will be allowed. Okay, so 7.5% and 10% will be allowed, so it's coming to 0.3 and 0.4. Okay, now plant and machinery 40% block put to use for less than 180 days, hence depreciation restricted to 20%, that is 50% of 40%. Okay, so computer installed in office premises, in that only depreciation will be allowed, in normal depreciation will be allowed as is written. Additional depreciation, plant and machinery, any machinery, plant and machinery installed in office premises, no additional depreciation allowed on that, so it is normal depreciation will be allowed on that. So it is written only normal depreciation column 1 and Z dash, and computer installed in factory, in that additional depreciation will be allowed. So 2 lakh and 2 lakh is written in both the columns. So total it's coming to 3 and 2. So on that 20% will be allowed on 3 lakhs. That rate of depreciation 40%, but as it is used for less than 180 days, normal depreciation will be 20%, and additional depreciation will also be 50%, that is 10%. Okay, so it is depreciation is coming to 0.6 and 0.2. Okay, now plant and machinery 40% block put to use for 180 days or more. New windmill purchased and installed on 18 June 2019. It was given 22 lakhs will be written on both the column. In this 40% and 20% depreciation will be charged. So normal depreciation at the rate of 40% and 20%. As you all know, windmill purchased on or after 1st April 2014, on that 40% depreciation is charged. So 8.8 and 4.8 depreciation is charged. So total depreciation, additional depreciation, they are calculating the total depreciation and additional depreciation. So plant and machinery 15% block, that is they are doing a total of that. I'm showing you what total they are doing. Okay, they are doing total of A plus B. A plus B means that is A, that is on which 180 more than 180 days full depreciation was charged, and half depreciation, so 13.05 and 3.3. So it's coming to 13.35, and additional depreciation is calculated accordingly. And on plant and machinery 40% block, so it's 40% block, it is 0.6 and 8.8, so it's coming to 9.4. in additional depreciation 0.4, 0.2 and 4.4, that is coming to 4.6. So total depreciation available under section 32, that is total, that is 13.35 plus 17.2 plus 9.4 plus 4.6, total is coming to 44.55. total depreciation will be charged. Okay, so we have to calculate the total depreciation as well as WDV as on 1st April 2020. So we will compute the WDV as on 1st April 2020. Let's calculate that. Computation of WDV as on 1st April 2020, plant and machinery 15%, 40% block is given. WDV as on 1st April 2019, there is nil. The company has started during the company was started during the year as given in question, so nil will be the opening WDV. Plant and machinery acquired during the year, so 84 lakhs, 3 lakhs, 4 lakhs and 12 lakhs. So total is 103 lakhs. Though on new imported machinery, it has been purchased during the year but not put to use, in that depreciation will not be given, but it will be added in the block of asset. Okay, so it has been added that, and in this imported machinery no depreciation has been charged. Okay, in the above calculation we have not charged depreciation. On 84 lakhs we have computed depreciation, on 3 lakhs we have computed depreciation, and on 4 lakhs also we have computed depreciation. Okay, so we have computed additional and normal both depreciation. Okay, and now let's see move. A new windmill purchased and installed on 18th June 2019, 22 lakhs, that is will be covered in 40% block. And computer installed in office premises, that is on the also in 40%, 1 lakh. And installed in factory computer, that is 2 lakh. Total is 25 lakh, and on which 15% block total purchase is 103 lakh. Okay, less assets sold in India, no asset has been sold, so nil it is. So WDV as on 31st March 2020 before charging depreciation. This is the WDV before charging depreciation. So less depreciation for the previous year 1920, that is normal depreciation. We have completed the total. Okay, so normal depreciation they are doing normal and additional depreciation separately, that is 13.35 and 17.2 in case of 15% block, and 9.4 and 4.6 in case of 40% block. So WDV as on 1st April 2020 is coming to 72.45 in respect of 15% block, and 11 in case of 40% block. Okay, hope you have understood this one. Let's see, 2 notes is given for that. What are the notes? Windmills and any specifically designed device which are run on windmills installed on or after 1st April 2014 would be eligible for depreciation at the rate of 40%. As I said, on windmill on a purchase on or after 1st April 2014, 40% depreciation will be charged on that. Number 2, new imported machinery was not installed during the previous year 1920. Hence, it would not be eligible for additional depreciation under additional depreciation for the assessment year 2021. It will also not be eligible for non-depreciation for the assessment year 2021 since it was not put to use in the previous year 1920 during the year of acquisition. Okay, so no normal depreciation, no additional depreciation. Number 3, it was noted that investment in the following plant and machinery would not be eligible for additional depreciation under section 32(1)(2)(a). That is lorry for transporting goods to sale depot, being vehicles or road transport vehicles. Okay, and computer installed in office premises in this 2 plant and machinery, no depreciation will be, additional depreciation will not be given. Okay, note number 4, as per section 228 of the Motor Vehicle Act 1988, the definition of vehicles excludes inter alia vehicles of special type adopted for use only in the factory or in an enclosed premises. Therefore, flock lift truck used inside the factory would not fall within the definition of vehicles. Hence, it is eligible for additional depreciation under section 32(1)(2)(a). Okay, so it is not considered in the vehicles. So in this, normal depreciation as well as additional depreciation has been charged. Okay, hope you have understood this one. Hope you have understood second question as well. So now let's start with question number 3, part A. Examine the taxability and or allowability of the following receipts or expenditure under the provision of the Income Tax Act 1961 for the assessment year 2021. S Limited receives a sum of rupees 10 lakh from K Limited on 3rd January 2020 for agreeing not to carry on any business relating to computer software in India for the next 3 years. So S Limited is receiving 10 lakhs from K Limited. Okay, so in this case, S Limited which is receiving 10 lakh rupees in the hands of S Limited, it will be chargeable under the head profit and gain from business or profession. Okay, and K Limited has to deduct TDS under section 194 while making the payment of 10 lakh rupees, and that 10% deduction will be TDS should be deducted by K Limited. Okay, while making payment to S Limited for non-compete fees. So in case of section 194J TDS section, that is on that it is written that non-compete fees up to rupees 10,000 up to rupees 30,000, no TDS has to be required to be deducted, but the amount of for non-compete fees it is giving 10 lakh rupees, so TDS will be deducted at the rate of 10% in this. Okay, let's see the answer. As per section 28(5), any sum received under agreement for not carrying out any activity in relation to business or profession, that is non-compete fees, is chargeable to income tax under the head profit and gain of business or profession. Accordingly, 10 lakh received by S Limited from K Limited for agreeing not to carry on any business relating to computer software in India for the next 3 years is chargeable to income tax under the head profit and gain of business or profession. The amount shall be allowed as deduction in the hands of K Limited provided tax has been deducted at source under section 194J on the payment so made to S Limited. If tax is not deducted at source, 30% of expenditure shall be disallowed under section 40 AIA. Okay, so if the tax is not deducted by K Limited, okay, while making payment to S Limited, then 30% of that amount, that is 3 lakh rupees, will be disallowed to K Limited while making the payment if he has not deducted TDS. Okay, hope you have understood this one. Now moving to Roman 2 of part A. Secret commission was paid during the previous year 1920. So secret commission, okay, the commission which is secret commission might not be allowed, because if you consider as an illegal commission, okay, that in case of commission which is not allowed as per law, that is illegal commission, if you are paying, then it will not be allowed while computing the income under the head profit and gain of business or profession. Okay, if it is a legal commission, then it will be allowed. If it is an illegal commission, as the word says secret commission, so it can be considered as illegal. If it is considered as illegal, then no deduction will allowed in respect of that. Okay, let's see the solution. Secret commission is one of the form of commission payment generally made by business organization. Okay, secret commission is a payment for obtaining business order or contract from parties and or customers and paid to employees and or officials or those parties and or customers or companies from whom business order are obtained by the SEC. So secret commission is generally paid. They have written why they are paid, that is for bringing orders, for bringing work, for bringing business to the organization, then company is paying the secret commission. Okay, they are saying why the secret commission is paid and to whom it is paid is written that only. So explanation 1 below, section 37(1) of the Income Tax Act provides that any expenditure incurred by the SEC for the purpose which is an offence or which is prohibited by law shall not be deemed to have been incurred for the purpose of business, and no deduction or allowance shall be made in respect of such expenditure. Okay, as I said, if it is illegal and it is not as per law, then it will not be allowed a deduction. In view of the explanation, any expenditure incurred for the purpose which is an offence and prohibited by law cannot be allowed as expenditure. Therefore, if secret commission payment could be established as payment for an offence prohibited by law, the same could not be allowed a deduction. If it is secret commission has been established, if it is established that secret commission is as per the prohibited law, so it will not be allowed a deduction while computing the business income of the organization which is paying the secret commission. Okay, hope you have understood. Now Roman 3 question. P Limited paid dollar equivalent to 50 lakhs as a sale commission for the year ended 31st March 2020 without deducting tax at source to Mr. Rodriguez, a citizen of UK and non-resident, who acted as an agent for booking orders from various customers who are outside India. So P Limited is paying rupees 50 lakhs as commission outside India to Mr. Rodriguez, a citizen of UK. It is paying outside India. Okay, and he is an agent outside India. Okay, the commission is paid to a person who is not a resident and it is outside India, and he is bringing business, okay, booking orders from outside India only. Okay, so in this case, even though P Limited has not deducted TDS, no disallowance will be made and entire 50 lakhs will be allowed to P Limited, as because the income is not accruing or rising in India and it is not taxable in India, so no question of deduction of tax has arisen. So P Limited will get the deduction of 50 lakhs and no disallowance will be made in respect of payment made of 50 lakhs to Mr. Rodriguez, okay, a citizen of UK. So let's see the answer. Sorry. See the answer. A foreign agent of an Indian exporter operates in his own country, and no part of his income accrues or arises in India. His commission is usually remitted directly to him and is therefore not received by him or on his behalf in India. No income is received in India. The commission paid to non-resident agent for service rendered outside India is thus not chargeable to tax in India. As I said, it is not chargeable to tax in India. Since commission income for booking orders by non-resident which remains outside India is not subject to tax in India, disallowance under section 40AI is not attracted in respect of payment of commission to such non-resident outside India, even though tax has not been directed at source. Okay, no disallowance will attract, no tax has been, even though no tax has been directed at source, as it was not accruing a rise in India and is not chargeable to tax in India. Thus, the amount of 50 lakh rupees remitted to Mr. Rodriguez outside India in foreign currency towards commission would not attract disallowance under section 40AI for deduction of tax at source. Okay, no disallowance will be attracted. So let's move to part B of this question. Can the following transaction be covered under section 43 for disallowance? Okay, a bank guarantee given by the company towards tax liability. Okay, let's see what the answer says. For claiming deduction of any expense enumerated under section 43B, the requirement is the actual payment and not deemed payment. Okay, furnishing of bank guarantee cannot be equated with actual payment. Actual payment requires that money must flow from the SSE to the public exchequer as specified in section 43B. Therefore, deduction of any expense covered under section 43B cannot be claimed by merely furnishing a bank guarantee. CIT versus McDowell and Company 2000 Company Limited 2009 314 ITR 167 Supreme Court. So only on actual basis, okay, only on actual payment basis of payment of interest, okay, then only deduction is allowed under section 43B, and merely giving a guarantee, that does not mean the payment has been made, so no allowance under section 43B of the payment. Okay, of the payment, not as the payment was not made, no allowance will be made under section 43 for claiming deduction, as no actual payment was made. It is on actual payment basis or not deemed payment basis. Okay, now moving to part B, Roman 2 of part B. Interest payable to goods and service tax department but not paid before the due date specified in section 139(1). So it will not be allowed because it is written in that section that it should be paid up to the due date of filing of return. Okay, so interest payable to goods and service tax department, that is covered as a tax. Okay, so interest payable to GST department not paid, so as per section 43B, no deduction will be allowed in respect of that, and it has not been paid. Let's see the solution. Interest payable to goods and service tax department is part of goods and service tax. Therefore, interest payable to goods and service tax department which is not paid before the due date of filing of return of income would attract disallowance under section 43B. Mewar Motors versus CIT 2003 260 ITR 218 Rajasthan, I think. Okay, so it will be disallowed and will not be allowed as deduction. Hope I understood. It was a simple question. Moving to question number 4. ILT Limited is engaged in manufacturing of pipe and tubes. The profit and loss account of the company for the year ended 31st March 2020 shows a net profit of 405 lakhs. So net profit is given. The following information and particulars are furnished to you. You are required to compute the total income of the company for the assessment year 2021, indicating the reason for treatment of each item. You have to indicate the reason of treatment of each item. Okay, a group free air ticket was provided by the supplier for reaching a certain volume of purchase during the financial year 1920. The same is encashed by the company for 10 lakhs in the April and created to general reserve. Okay, company is receiving, okay, freebies from the supplier. Okay, so it will be chargeable to tax, so it will be added while computing the profit and gain for business or profession. Okay, so in this it has not been considered, so it will be added while computing the business and profession. Number 2, a regular supplier of raw material agreed for a settlement of 8 lakhs instead of 10 lakhs for poor quality of material supplied during the previous year, which was not given effect in the running account of the supplier. Okay, so 10 lakh was payable and it has been reduced to 8 lakh. So we are assuming that 10 lakh has already been allowed in the previous years. Okay, so only 8 lakh we have to pay, so we can consider it that 2 lakh 8 lakh should have been allowed, while they have claimed 10 lakh as deduction in the previous year. So 2 lakh will be added and it will be charged to tax. Okay, because only as 8 lakh should have been deducted while computing business and profession of the previous year, whereas they might have deducted 10 lakh. So 2 lakhs should be added back as the amount is being settled at 8 lakhs. So liability is being waived off to 2 lakhs. So it will be chargeable to tax. Number 3, Andhra Bank. I'll explain to you. I'll show the solution. I'll read the solution. You will get to know what I'm saying and you'll see the answer after reading all the part. Andhra Bank sanctioned and disbursed a term loan in the financial year 16-17 for a sum of rupees 50 lakhs. Interest of 8 lakh rupees was in arrears. The bank has covered the arrears interest in a new loan repayable in 10 equal installments. Okay, during the year the company has paid 2 installments and the amounts of paid has been reduced from the funded interest in the balance sheet. Okay, as we have seen in the previous illustrations also, in one of the illustrations, that whenever any loan interest is converted into loan, okay, so when the actual that interest is payable, that only is allowed as per section 43B, only on actual payment basis of interest. It is allowed deduction. When the loan is converted into interest is converted into loan, then it will not be considered as repayment payment of interest. When that loan, the interest which is converted into loan, when it is actually paid, that only will be allowed deduction. So in this case only 2 installments is been paid, so only 1,60,000 will be allowed as deduction. That is 8 lakh divided by 10 installments into 2 installments. Only 1,60,000 will be allowed as deduction. Okay, we'll see the solution. The company remitted rupees 5 lakhs as interest to company incorporated in US on loan taken 2 years ago. The TDS under section 195 from such interest has been deposited by the company on 15 July 2020. The said interest was debited to profit and loss account. Okay, so the company has remitted 5 lakhs as interest to a company incorporated in US on loan taken 2 years back. The TDS under section 195 from interest, such interest has been deposited by the company on 15 July. So the said interest was debited to profit and loss account. So no treatment will be there as it was allowable. Interest allowable and it has been already debited to profit account. No treatment will be there. Now moving to 5th one, Sandeep, a sale executive stationed at head office at Delhi, was on official tour in Bangalore from 31st May 2019 to 18th June 2019 and 28th September 19 to 15th October 2019 for business development. Okay, Sandeep, which was an executive at head office in Delhi, was going on official tour. Okay, they have given the date from which day he has gone for official tour in Bangalore. The company paid Sandeep salary in cash from its local office in Bangalore for the month of May 2019, payable on 1st June and September 2019 payable on 1st October, amounting to rupees 45 lakhs and 47 lakhs respectively, net of TDS and the other deductions, as Sandeep has no bank account in Bangalore. These were included in the amount of salary debited to profit loss account. So no treatment as Mr. Sandeep is going for 15 days or more. Okay, whenever any person is going from his own place of business is going to different place of business for 15 days or more, then he can be given a cash as he has no bank account and it will be allowed as deduction to the company. Okay, in this case 47 lakh and 45 lakh both will be allowed as deduction as TDS has been deducted by the company, and all the deduction which was required to be deducted, it has been done, and it has been paid as it is allowed in section 48(3) rule 6DD. So no disallowance will be attracted, and it has been already been debited, so no treatment will be there. Okay. Okay, this has already been included in the salary and debited to profit account, so no treatment will be there. Okay, the company has contributed 50,000 by account pay check to an electoral trust, and the same stands included under the head general expenses. So it will on this case 80 GGB section deduction will be allowed as per section 6A, and it will be added from the while computing PGBP income. Okay, it will be added. Let's see the solution. Computation of total income of ILT Limited for the assessment year 2021. Profit and gain from business or profession, net profit and net profit as per the profit loss account is 405 lakhs. Add items debited to profit loss account but to be disallowed. We have to add the items which should have not been allowed and it has been already been allowed, and items not considered in the accounts but to be taxed. So with items which should have been considered while taking business income, which has not been considered, that will be added. Both two things will be added. The items which has already been debited and which should not have been debited will add that, so that profit will increase. Okay, and items which was not shown as per the accounts for the taxable purpose, that should be also be added. Okay, so let's see. Value of group free air tickets provided by a supplier is taxable as business income under section 28(4), as the value of any benefits, whether convertible into money or not, arising from business is taxable as business income. So it was not considered while calculation of 405 lakhs, so it will be added back and profit will increase as it will be chargeable under that business income. Okay, I told you before only that it was received from supplier, so it will be chargeable under that business and profession. Next one, amount waived by a supplier of raw material is deemed income under section 41(1) as the expenditure was allowed as deduction in the last year, and there is a benefit by way of remission or cessation of trading liability. So trading liability has been reduced to 2 lakhs. The fact that effect was not given in the running account of the supply is not relevant. That is not relevant, and we have to add back 2 lakh rupees. Okay. Next one, interest payable outside India to foreign company is allowable. Okay, so it has already been charged to the profit and loss account, so no treatment will be there. Contribution to electoral trust is not an allowable expenditure while computing business income, hence the same has to be added back since it is included in general expense. So it is included in general expense, it should not have been allowed, so it has already been charged to general expense, so we'll add back and will increase the profit. Salary paid to employees Sandeep is eligible for deduction. Disallowance under section 48(3) will not apply. Okay, no disallowance will apply as it has already been charged to profit loss account, and so no treatment will be there. So total added back is 10 plus 2 plus 0.5, it's coming to 12.5 lakhs. Okay, so total after adding is coming to 405 plus 12.5 is coming to 417.5 lakhs. Okay, less the amount of deduction allowable under section 43B. Interest on loan due to any scheduled bank etc. is allowable as deduction if such interest is actually paid irrespective of the method of accounting followed by the SEC. Okay, conversion of arrears of interest into fresh loan by a bank cannot be considered as actual payment of interest. As I said, it will not be considered actual payment, and only actual payment, actual interest, interest which was converted in loan and which is in installments which is paid, that will be a dollar deduction. As I said, 1,60,000, that is 10 lakh divided by 8 lakh divided by 10 into 2 installments, that will be allowed as deduction. However, the amount of funded interest, that is converted loan, actually paid is allowable as deduction. Hence 1,60,000 being 2 installments of 80,000 each, actually paid is deductible. So 1,60,000 is deducted. So business income is coming to 415.90 lakhs. Gross total income is 415.90 lakhs, less deduction under chapter 6A, as I said, that 50 lakhs which was disallowed, that will be allowed as deduction under section 80 GGB. Deduction under section 80 GGB in respect of contribution by the SSC company to the electoral trust is 0.5 lakhs. So total income is coming to 415.4 lakhs. Okay, note is there. Let's see the note. Since tax has been deducted on interest payable outside India to foreign company during the previous year 1920 and the same has been deposited before the due date of filing of return of income under section 139(1), disallowance under section 40A is not attracted. Since the interest already been debited to profit and loss account, no further adjustment is required. Okay, so no adjustment is required. It is note for this adjustment. I am showing you that interest payable outside India to foreign company is allowable. Okay, note is given, and second note is for salary purpose, that is paid to Sandeep. Let's see the notes. In respect of payment of salary to sales executive in cash, no disallowance under section 40A3 is to be made, as the payment falls within the scope of section rule 6DD1. Salary paid to him in cash is allowable as the executive was temporarily posted for a continuous period of more than 15 days in Bangalore, which is not the place of his normal duty. Okay, it was not the place of his normal duty. He is there for more than 15 days. Further, tax was deducted from such salary under section 192 and he does not maintain any bank account in Bangalore. No disallowance under section 48(3) is attracted in respect of such salary. Okay, no disallowance will be attracted and it will get the deduction, so no adjustment was done because it has already been charged to profit loss account. Hope you have understood this one. Now let's move to question number 5. Hope you have understood all the 4 questions. Now let's move to last question of this video. G Limited, a company in which public are substantially interested, okay, is engaged in the business of growing and manufacturing of tea in India. For the previous year ended 31st March 2019, its composite business profit before allowing deduction under section 33AB is 60 lakhs. Okay, the previous year 31st March 2019 composite profit is given for 31st March 2019. Okay, on 1st September 2019 it deposited a sum of rupees 11 lakh in the tea development account. Okay, during the previous year 17-18 G Limited had incurred a business loss of 14 lakhs which has been carried forward. On 25th January 2020 it withdrew 10 lakh from the deposit account which is utilized as under. So as you all remember that in case of deduction under section for the purpose of Pgbp under section 33AB, okay, the amount should be deposited in the deposit account on or before 30th September, that is due date of filing of return. In case of company it is due date of filing of return is 30th September. So the amount has been deposited before the due date of filing of return, that is this 30th September. So on 11 lakhs G Limited will get the deduction for the 11 lakh rupees in the financial year 19. Okay, financial year 31st March financial year 30th March 18-19. Okay, as on 60 lakh if we compute 40%, okay, deduction is allowed 40% of amount or amount deposited whichever is lower. So if we compute on 60 lakhs 40% is coming to 24 lakhs and 24 lakhs and 11 lakhs whichever is lower is 11 lakhs. So 11 lakh will be allowed as deduction to G Limited for the previous year 18-19, and as it is the amount has been deposited before the due date of filing of return. Okay, so 14 lakhs were lost for the 17-18 and on 19-20 previous year 19-20 the amount is withdrawn from that account is 10 lakh. So already 11 lakh has been allowed. So on withdrawal of this amount and utilizing the amount, no more deduction will be allowed, and if it is not utilized for the specific purpose, the amount which has been withdrawn, then it will be chargeable to tax. Okay, so let's see how the amount has been utilized which has been withdrawn on 25th January 2020. 6 lakh for purchase of non-depreciable asset as per the specified scheme. So as per the specified scheme, the amount the 6 lakh have been purchased for non-depreciable assets, so no disallowance will be there. 3 lakh was purchase of machinery to be installed in office premises. So in section 33AB it's written that if any amount is withdrawn and utilized for office appliances or office premises, so it is not as per the scheme, so it will be disallowed, and so amount has already been allowed. So from 11 lakh 10 lakh has been withdrawn, so 11 lakh was allowed. So while computing the Pgbp of further so 3 lakh which has been utilized for other purpose other than the scheme, okay, so 3 lakh will be taxable in the previous year 1920, okay, and 1 lakh was spent for the purpose of the scheme on 5th April 2020. So it is written in the provision the amount should be utilized in the year of withdrawal only, okay. So the amount is withdrawn on 25th January 2020, that is previous year 1920, but the amount has been utilized in next year, that is as previous year 2021. So 1 lakh will be taxable in the previous year 1920, okay. So first, what we are required to compute, you are required to determine the business income of G Limited and the tax consequence that may arise from the above transaction in the relevant assessment year. We have computed the business income of G Limited and tax consequences, okay. What will be the consequence if the assets which was purchased for 6 lakhs is sold for rupees 8 lakhs in April 2020? So it is written in the provision the assets which is purchased after withdrawal should not be sold before the expiry of 8 years from the end of the previous year in which it was acquired. So it has sold before that, so tax consequence will be there. We'll see how the tax consequence will be computed. So let's see the solution of first part. Computation of business income of G Limited for the assessment year 2021. 10 lakh rupees being the amount withdrawn from T development account has been utilized in the prescribed manner, otherwise the withdrawn amount would be chargeable to tax as business income, okay. So it has been withdrawn, and so in the given case the taxability of withdrawal amount based on their utilization is as follows. 6 lakhs out of the amount withdrawn from the deposited account utilized for the purchase of non-depreciable asset as per the specified scheme, it is not taxable as it is used as per the specified scheme. As per section 33AB6, no deduction would be allowed under section 33AB since the amount is spent out of 11 lakhs deposited in T development account, which it has already been allowed a deduction in the assessment year 1920. So okay, so as I said that in the previous year 1819, that is assessment year 1920, the amount has already been allowed. So from that amount only which has already been allowed, from that amount only the amount of 6 lakh rupees has been withdrawn, so no deduction will be allowed, and no taxability as it is used for the specified purpose as per the scheme, okay. They are showing some working how they have the amount has been utilized, and I'll show you, they will show you the calculation of 60 lakhs and minus 11 lakh, that is lower of 24 lakhs and 11 lakhs. Let's see the working note, okay. Working note, computation of business income G Limited for the assessment year 1920. Composite business income before allowing deduction under section 33AB is 60 lakhs, okay. Less deduction under section 33AB1 would be lower of amount deposited in T development account on or before 30th September 2019, that is 11 lakh, okay. And 40% of profit of such business, that is 24 lakh being 40% of 60 lakh, so lower is 11 lakh, so low 11 lakh has been allowed, okay. And income is profit is coming to 49 lakh, okay. On that case 60% is agriculture income, as you all know that 40% is business income and 60% agriculture income. First we will compute that only. 60% of 49 lakhs, 60% of 49 lakhs being agriculture income as per rule 8, that is 29 lakh 40,000 is agriculture income, so business income is 19 lakh 60,000, okay. And it was given in question that for the previous year 1718 brought forward loss of previous year 1718 was 14 lakh, so brought forward loss of the assessment year 1819, that is previous year 1718, set off as per section 72, that is 14 lakh is set off, so business income chargeable to tax was 5 lakh 60,000 for the previous year 19 31st March 2019. Okay, hope you have understood. So let's move up where we were there before. So we have seen the working note. Let's see what is the treatment of 3 lakh. 3 lakh being the amount utilized for purchase of machinery to be installed in office premises is not permissible utilization. Hence the amount would be deemed as profit and gain of business of the previous year, that is 1920, as per section 33 AB4. Okay, so 3 lakh will be taxable as it was not utilized as per the permissible utilization. So 3 lakh will be taxable. So treatment of 1 lakh. 1 lakh was spent for the purpose of scheme on 5th April 2020. As per section 33 AB7, this amount would be taxable since the same is not utilized during the previous year, that is previous year 1920, in which the amount is withdrawn from the deposit account. So as I said, in the year it should of withdrawn it should be utilized, so it has not been utilized for that year, in that year, so it will be chargeable to tax. Okay, so when, now let's see what they're saying next. When any part of withdrawal amount becomes taxable, the agriculture and non-agricultural portion of income must be segregated. So on this 4 lakh we have to segregate agriculture portion income and non-agriculture income. So 40-60 will be done. So accordingly 1,60,000 being 40% of 4 lakh, that is 3 plus 1 lakh 4 lakh. 40% of 4 lakh is coming to 1,60,000 would be chargeable to tax as business income, and the balance of 2,40,000 being 60% of 4 lakh would be agriculture income exempt from tax. Okay, so hope you have understood this one. So let's see the second part of this question. It was a good question. You can see it before the examination. It can be asked. If you see it, it will be easy to solve, and we have to write the note as well. Whatever working note is they're showing, you have to write that, and if we'll read once, it will be easy for us to answer the exam in the examination. We can solve it as fast as possible. So let's see part 2 of this question. Consequence: if the asset purchased out of deposit account is sold during the previous year 2021. Okay, as per, let's see what the question was asking. Read the question second part again. What will be the consequence if the assets which were purchased for 6 lakhs is sold for 8 lakhs in April 20? Okay, so it is sold before the expiry of 8 years. Okay, from the year of purchase, from the end of the previous year in which it was purchased, it is sold before the expiry of 8 years. Okay, so there will be a tax consequence. Consequence if the assets purchased out of deposit account is sold during the previous year 2021. Okay, as per section 33 AB8, if the asset is sold before the expiry of 8 years from the end of the previous year in which it was acquired, then the cost of such asset shall be deemed to be the profit and gain from the business or profession of the previous year in which asset is sold. Okay, so it will be in this year only, previous year 2021, it will be taxable. Therefore 6 lakhs would be deemed to be business income, that is composite, for the assessment year 2021. Hence, that is previous year 2021 and assessment is 21-22. Okay, hence the full cost of asset was deducted in the assessment year 1920 being part of, that is previous year 18-19. Assessment is 1920, so being part of 11 lakhs deposited in the T development account. Okay, before segregation of agriculture income and the non-agriculture income, the agriculture and non-agriculture portion of income should be segregated in the year in which such amount become taxable on account of sale of assets before the expiry of 8 years. So in this also, of 6 lakhs will do 60-40. 60% will be agriculture income and 40% will be business income. Okay, therefore 3,60,000 being 60% of 6 lakh would represent agriculture income. The balance 2,40,000 being 40% of 6 lakh would be chargeable to tax as business income. Okay, moreover, the difference between the sale consideration and purchase price of the asset would be chargeable to short-term capital gain, as it was sold before the expiry of 36 months. Okay, so it will be short-term capital gain, which is computed as follows: sale consideration is 8 lakh and less cost of acquisition is 6 lakhs, so it will be short-term capital gain. So let's see whether it was depreciable assets or not. Non-depreciable assets, so it is non-depreciable asset and is showed before the expiry of 36 months, so it will be long-term capital gain. Hope everyone understood this one. So that's it with fourth part of Pgbp. If there is a doubt, write me on comment box. Don't forget to subscribe the channel. I'll be soon uploading the fourth part, and which will be the last part, in which I'll be covering all the rest of the exercise questions. Do subscribe the channel and also share with your friends, okay, and also click on the bell icon for more updated videos. Study hard, stay healthy, okay. And one more announcement: anyone willing to solve ICI indirect tax questions, please click on the link given in the description. Okay, thank you very much. Bye bye.